Hi everyone, my name is Dinesh Sabu, and today in this course, as a part of this course, I'm going to take you through one of the most rapidly evolving and deeply influential frameworks in modern business, which is ESG, stands for Environmental, Social and Governance. Now, this isn't just a trend. It's a transformation in how companies operate, how investors allocate capital, and how society as a whole defines corporate success. So, whether you are a student, you are an entrepreneur, or a financial analyst, or overall a policymaker, understanding ESG is now a fundamental part of navigating today's economy. So, over the next few minutes, we will what ESG truly means. We will explore its historical roots. We will address the misconceptions around ESG and examine where it's headed, all from a beginner yet comprehensive perspective. So, let's talk about ESG trends and innovations. This is a beginner's guide to the future of responsible business. Again, my name is Dinesh Sabu and I am a CFA charter holder. So, what we will cover here is the table of contents given below on the right. We'll cover introduction to ESG, environmental pillars of ESG, social pillar of ESG, and then the governance pillar of ESG. Then we'll also talk about regulations and reporting standards. We'll talk about ESG investing landscape, technological innovations in ESG, then challenges in ESG implementation. We'll also see some case studies and the real world impact. And last but not the least, we'll also discuss about the future of ESG. So let's now talk about ESG as an introduction. ESG, E stands for environmental, S for social, and G for governance. Okay. Now, environmental, social, and governance. These are the three key areas that measure the non-financial performance of an organization. In simple terms, ESG is a framework that helps us assess how responsibly a business is operating beyond just profits. So, the environmental pillar looks at how a company interacts with the planet, carbon emissions, pollution, energy use, waste management. The social pillar focuses on people, labor practices, diversity, community impact, overall employee well-being. And the governance pillar covers leadership and oversight, board diversity, executive pay, transparency, and anti-corruption policies. What's important to note is that ESG is not an abstract concept. It has become a major decision-making factor for investors, regulators, employees, and even customers. So whether it's BlackRock integrating ESG across its portfolios, or Gen Z choosing to work for purpose driven companies, ESG now is a central to value creation overall. So, now let's discuss a little bit about the history and evolution of ESG. So, while ESG may feel like a modern buzzword, its philosophical roots go back decades. In the 1960s, investors began applying socially responsible investing or SRI principles to companies involved in alcohol, tobacco, weapons, etc. This moral approach evolved in the 1990s and early 2000s into corporate social responsibility, also known as CSR, where companies engaged in philanthropy and community outreach. But the point is that these efforts were often disconnected from the core strategy. Then entered ESG, which is a data driven, investment oriented framework that emerged in the mid 2000s. And the term gained traction after a 2005 UN report titled Who Cares Wins. This report argued that companies with strong ESG performance would be more sustainable and more profitable in the longer term. And since then, ESG has grown into a multi trillion dollar industry, not just an ethical idea, but a very, very measurable, reportable business strategy. So why ESG matters today and why is ESG so important right now? So there are three key reasons. First one is long-term value. The companies that manage environmental risk, treat employees well, and maintain ethical governance are more likely to outperform over time. So ESG is no longer just about values, it is about viability. Second is the stakeholder pressure. So investors, regulators, employees, and consumers all now expect transparency on ESG issues. A company that fails to disclose climate risk or diversity metrics may lose funding, talent, or even public trust. And the third is reputation and access to capital. So firms with stronger ESG ratings, they attract more capital. So there are green bonds, ESG linked loans, and sustainability funds are rising exponentially across the world. In short, ESG has now become a competitive advantage. Now let's talk about the environmental pillar of ESG. So the first and our most visible pillar of ESG is environmental, and for a very good reason. So climate change, biodiversity loss, pollution and resource depletion, these are among the most pressing global risks that we face on a day-to-day basis. But environmental responsibility currently isn't just about saving the planet. It's about economic sustainability. So poor environmental practices, they may lead to regulatory fines, they may lead to reputational damage and operational disruption. On the flip side, we see that companies that invest in clean energy, waste reduction, and resource efficiency measures, they are often rewarded with cost savings, brand loyalty, and risk reduction. In ESG terms, we are moving away from seeing environmental responsibility as philanthropy and more seeing it towards as a strategy. Now let's begin with the concept of climate risk. And this climate risk as a concept has become a central financial concern. So businesses are increasingly exposed to two types of climate risk. First is physical risks. Physical risks could include risks such as extreme weather events, rising sea levels, and droughts that disrupt supply chains, they destroy assets, or they endanger workers. And then the second type of risk is transition risks. Transition risks are related to the policy, legal, and the market changes that come with the move to a low carbon economy. Now, let me give you an example to explain this more clearly. For example, a logistics company may suffer from both rising fuel costs. Now, this is transition risk. And then it could also suffer from flooding of its distribution centers. This is physical risk. So, to manage this, companies must measure and disclose their carbon footprint, which includes the following. Now, this is very, very important. Please note this. So, Scope 1 is direct emissions from owned sources, example, company vehicles. Then there is Scope 2. Scope 2 is indirect emissions from purchased electricity, etc. And then there is scope 3, all other indirect emissions, including supply chain, employee commuting, and even product use, etc. Now, investors and regulators are increasingly demanding this data, not just as a formality, but because it's linked to business continuity and valuation. Let me give you an example. So, if a manufacturing firm has a high scope 3 footprint due to coal heavy suppliers, it may face pricing penalties or financial difficulties. So now let's talk about sustainable energy and emissions. Closely tied to the carbon accounting is the company's energy strategy. What we are witnessing a global shift towards renewable energy overall. Solar, wind, hydro, and even emerging sources like green hydrogen. So for businesses switching to clean energy, it's no longer just a feel good initiative, it's a hedge against volatility and regulation. And governments around the world are setting net zero targets. Please focus here, net zero. That means companies too are setting internal goals to reduce their greenhouse gas emissions, also known as GHG emissions, over time. But here is the challenge, it's not about pledges, it is about execution. So investors want science-based targets verified through programs like Science Based Targets Initiative. They want proof that companies aren't just buying carbon offsets but are genuinely decarbonizing operations. So let's take Microsoft as an example. So Microsoft has pledged to be carbon negative by 2030, meaning it will remove more carbon than it emits. And by 2050, it aims to remove all the historical emissions since its founding in 1975. This is the level of ambition and accountability ESG stakeholders are now expecting. So while carbon gets the other headlines, the other environmental issues like waste and water are equally critical, especially in sectors like food, pharmaceuticals, apparel, and heavy industry. Now let us break this down. Waste management involves reducing the landfill disposal, promoting recycling, and moving towards a circular economy where materials are reused and waste is minimized. And water stewardship means not only reducing the usage but ensuring water is returned to the ecosystem very, very clean and safe. Companies like Unilever, etc., are leaders in circularity, designing products to be reused, repaired, or recycled. Meanwhile, tech firms like Intel are achieving water positivity, returning more clean water to the environment than they consume. But ESG isn't just about internal operations, it is about the supply chain too. So a consumer goods company may manufacture its products cleanly, but if its suppliers pollute rivers or overuse groundwater, the ESG score drops. So this creates pressure for full life cycle sustainability. In short, if you are not managing your waste and water, you are not managing your risk overall. Now let's talk about biodiversity and resource usage. So the final environmental theme is the one that's often overlooked: biodiversity. And what is biodiversity? Biodiversity refers to the variety of life on Earth: plants, animals, ecosystems, and it's essential to everything from agriculture to pharmaceuticals. So now companies are being asked these questions. Questions like: are your operations causing deforestation? Is your supply chain harming endangered species or habitats? Are you extracting resources like timber, minerals, or seafood in ways that are destroying the ecosystems? So, take palm oil, a common ingredient in food and cosmetics, right? Its unsustainable harvesting is a major cause of rainforest loss in Southeast Asia. It's a very, very well known fact. Now, ESG focused investors are screening companies for certified traceable palm oil sourcing. So, some firms are adopting natural capital accounting, a way to measure the environmental resources they depend on, just like the financial capital. And regulators are watching. So, the European Union deforestation regulation, it requires proof that products sold in the European Union or EU are not linked to deforestation. Now, this is a game changer for global sourcing. This is where ESG becomes a driver of innovation. So, companies must redesign how they produce and source, and those who do gain trust, access to green capital, and longer term viability. So, now let's talk about the key takeaways and let's wrap up this session. So, the key takeaways are: the climate and environmental issues are now financial risks and opportunities. Carbon emissions, energy sourcing, water use, and waste are all under scrutiny. Companies must measure, reduce, and report across the value chain. Biodiversity and ecosystem are rising in importance. And environmental excellence isn't just about compliance, it's a competitive edge in today's business world. Now, when people hear ESG, they often think of the environment, carbon footprints, emissions, green energy. But let me tell you that the social pillar is just as critical as the environmental. In fact, it may be even more immediately visible because it's about how companies are treating their people, employees, customers, communities, and society at large. So the social pillar asks these kinds of questions. Are we creating inclusive, safe, and fair workplaces? Do our products uplift or harm communities? Are our supply chains exploiting labor or uplifting economies? So these kind of questions are typically asked. In a hyper-connected, media-driven world, one viral story about discrimination of or human rights violations can destroy years of brand equity. So the social performance is not soft, it is indeed strategic. Now let's break down the key components. So diversity, equity and inclusion, DEI. The first major theme under the social pillar is diversity, equity and inclusion, are commonly known as DEI. Diversity is about who is in the room. Are there people of different genders, ethnicities, backgrounds, and experiences? Equity ensures everyone has access to the same opportunities, resources, and outcomes. And inclusion is about the culture. Do people feel safe? People feel respected and empowered to contribute? Now, why does this matter? Because DEI is linked to innovation, decision making quality, and performance. Now, numerous studies by McKinsey, BCG, and similar other consulting groups have shown that diverse leadership teams outperform homogeneous ones, and not just morally but financially. So today's ESG reports, they often disclose gender and minority representation at different levels. There are pay equity audits, and there are DEI policies and training programs. For example, Salesforce as a company publicly reports on gender pay equity and adjusts compensation annually to close any gaps. Accenture publishes a full DEI dashboard online showing year on year progress. Now, this kind of transparency builds trust with employees and investors alike. Now, let's talk about labor practices and human rights. This is a foundational ESG topic. What this includes? This includes fair wages and working hours, freedom of association and collective bargaining, protection against forced and child labor, and safe and human working conditions. In developed markets, indeed, companies are expected to treat their direct employees well. But ESG also asks some critical questions, right? What about the suppliers? So, a fashion brand may have ethical headquarters, but if its clothing is stitched by underpaid workers in dangerous factories, it will fail the ESG test. So, high profile tragedies like the Rana Plaza collapse in Bangladesh, where over around more than 1,000 garment workers they died due to poor safety. These kind of incidents they brought attention to supply chain labor risks. Now, major firms conduct social audits, partner with certification bodies like SA 8000, and implement corrective plans to ensure compliance. Human rights are also increasingly tied to modern slavery legislation like the UK Modern Slavery Act and Australia's counterpart, which require disclosure and mitigation steps from large companies. So, in short, and to conclude, labor practices are no longer just an HR issue, they are a board level concern. Let's talk about customer and the community impact. So, beyond employees, ESG evaluates how companies impact their customers and communities. So, this includes product safety and ethical marketing, marketing only the genuine things, accessibility and affordability of goods and services, community development, donations, partnerships, respect for local cultures and social dynamics. Now let me give you an example. So consider Johnson and Johnson, whose product recall due to safety issues damaged the trust despite a very stronger brand. On the other end, there are companies like Danone or Tata Group. They are known for their very strong community involvement and local empowerment. So, social license to operate is a term you'll often hear in ESG discussions. It refers to public acceptance of a company's operations, especially in sectors like mining, energy, or agriculture. So, without that, the companies face protest, they face boycott, they face litigation. So, social performance directly affects a brand equity, sales growth, and regulatory risk. It also opened doors for impact investing and inclusive innovation. Now let's talk about health, safety, and employee well-being. Something that went from optional to essential during the COVID-19 pandemic. So health and safety used to mean just the physical safety. For example, hard hats, hazard signs, clean drinking water. Now it includes a lot of other things like mental health, work life balance, psychological safety, etc. So leading ESG companies, they are now reporting on workplace injuries and fatalities. Okay. Example, total recordable incident rate, TRIR. They also uh, they also report or talk about mental health support programs, remote work flexibility, and also a lot of focus on wellness initiatives like yoga, therapy subsidies, parental leave, etc. Now, to give you an example, Unilever has embedded well-being into its employee experience, linking it directly to productivity, retention, and employee morale. And here is the big shift: these aren't just perks, they are actually strategic levers. Healthy, supported employees, we all know, are more engaged, more innovative, more loyal. This translates to better performance, lower churn, and a stronger culture. So, the key takeaways from the social pillar, let us summarize. The social pillar addresses how companies treat people, both inside and outside the organization. Now, DEI, labor rights, customer impact, and employee well being are all central focus areas here. Okay. Social failures, they lead to reputational, legal, and financial risks. And excellence in social performance builds loyalty of the employees, customers, resilience, and longer term value. So, social responsibility is not just a moral obligation, it's a competitive differentiator these days. So now we arrive at the third pillar of ESG, and arguably the most foundational pillar, which is the governance pillar of ESG. So if environmental and social performance reflect what a company does, governance reflects how it makes decisions. So it is the invisible hand behind corporate behavior, setting the tone at the top, guiding risk management, and aligning incentives. So, without strong governance, even the best environmental and social programs can collapse under poor leadership, unchecked corruption, or strategic missteps. So, what does governance include? Governance includes board composition and independence, executive compensation, shareholder rights, ethical conduct, anti corruption, and whistleblower mechanisms. So think of governance as the control tower of a company, ensuring that it stays aligned, accountable, and agile. Now let's explore how this plays out in the real world ESG frameworks. Board structure and independence. So one of the first things ESG analysts look at is the board of directors, the group responsible for overseeing the management of the company and protecting the shareholder interest. So there are a lot of questions, and few key questions include: is the board majority independent? Are there clear roles between CEO and the chairperson? Is there diversity in gender, ethnicity, expertise, and age? Then are ESG competencies represented? Now, why does all this matter? Because boards shape the culture of a company. An independent, diverse board is more likely to challenge the group think, uncover risks, and push for more and more innovation. So, and conversely, a board stacked with insiders may be too cozy, allowing bad practices or ethical blind spots to persist. Now, let us talk about an example here. So, for example, Volkswagen emission scandal raised concerns about weak oversight and a culture that discouraged internal dissent. And on the contrary, Intel's board added directors with ESG expertise to better navigate the shareholder expectations. So today, proxy advisors like ISS and Glass Lewis, they assess board quality in their voting recommendations, making it a critical governance issue for public companies. Now let's deep dive a little bit more about this on the executive compensation and the ethics part of it. Okay. So here we will examine how top executives are paid and whether their incentives are aligned with the long-term ESG goals or not. So historically, executive pay has been tied to short-term financial metrics. These financial metrics are revenue, profit, share price, etc. Now, this led to behavior focused on quarterly results, sometimes at the cost of ethics or sustainability. But today, investors want to see balanced scorecards that include ESG metrics, example, emission targets, DEI progress, safety rates, clawback provisions to recover bonuses in the case of misconduct, and clear transparency in how performance is evaluated and rewarded. Now, let's talk about an example here. Apple, Shell, Unilever, These companies now link portions of executive pay to ESG outcomes. So, this signals to investors and employees that ESG is not a side goal, it is a core driver of leadership success. And ethical culture also starts at the top. So, if leadership models integrity, transparency, and responsibility, that behavior actually cascades down. Now, another key area of governance is how companies engage with their owners, which means the shareholders. Now, strong ESG governance it includes that equal voting rights for all classes of shareholders, regular transparent disclosure of financial and non-financial information, and responsiveness to shareholder proposals and concerns. So, for example, investors may propose resolutions on climate disclosure, board diversity, or supply chain ethics. And companies with strong governance take this very seriously, engaging constructively rather than defensively. So, transparency is very crucial. And ESG investors want more than just the glossy reports. They expect access to data, dashboards, and detailed analysis. And this is especially important in ESG because many of the performance metrics like emissions, diversity, or human rights, they aren't found in the traditional financial statements. So governance is primarily about building trust and accountability in the shareholder relationship and more broadly in how the company engages with the stakeholders. Let's talk a little bit about the whistleblower policies and anti-corruption. So, what is important is that the governance must include systems to detect and address the misconduct. So every organization, no matter how ethical its intentions are, faces the risk of internal wrongdoing. There could be fraud, there could be harassment, there could be data breaches, there could be regulatory violations, anything can happen. So ESG looks at whether the company has a clear whistleblower policy in place, okay, whether the company provides confidential protected reporting channels, whether the company has a mechanism to act swiftly and fairly on all reported issues, and whether the company upholds a zero tolerance stance on bribery and corruption primarily. See, well known scandals, right from Wells Fargo's fake account crisis to Wirecard's fraud, they show the high cost of poor internal governance. Strong companies they encourage employees to speak up and protect them when they do. Some companies they even create ombudsperson roles or external reporting platforms to ensure clear impartiality. And this ESG governance is about building a culture of integrity, safety, and justice, not just avoiding scandals, but actively preventing it. So let's talk about the key takeaways of this entire governance pillar. And to summarize, governance determines how responsibly and how strategically a company is run. Independent, diverse, and skilled boards are very essential for oversight. Executive pay should align with ESG and long term goals. Transparency and shareholder engagement builds trust. Very important. And strong ethics, anti corruption policies, and whistleblower protections, they protect value. So the governance is not just the G in ESG, it is the anchor that keeps the E and S from drifting off its course and binds all E, S, and G together. Now, one of the biggest drivers of ESG's growth is regulation. It is no longer just about voluntary action. ESG disclosure is gradually becoming mandatory. So, why does regulation matter in the ESG world? Because what gets measured gets managed, and what gets reported becomes part of accountability. So, today, companies are not only expected to disclose financial results, They must also share details about emissions, labor practices, board diversity, governance structures, and more. But here is the challenge: ESG reporting has been fragmented and inconsistent. Different countries, different sectors, and investors have used different standards, creating confusion and sometimes mistrust. So, let us walk through the most important frameworks shaping the ESG reporting landscape today. Global ESG reporting standards, GRI, SASB, etc. So, there are several major ESG standards, each with its own focus. So, GRI, Global Reporting Initiative, this is the most widely used standard globally. It focuses on the impact a company has on the world, environment, people, and communities. It's values driven and used across industries. SASB is the Sustainability Accounting Standards Board. It focuses on financial materiality, what ESG issues are likely to affect financial performance. It's more investor oriented and sector specific. And then we have TCFD, Task Force on Climate Related Financial Disclosures. So, developed by the Financial Stability Board, TCFD focuses on how climate change affects a company's financials, including governance, strategy, risk management, and metrics. We also have ISSB, which is the International Sustainability Standards Board. Now, launched to unify ESG reporting globally, it is expected to become the IFRS of ESG, setting standards that combine financial relevance with the sustainability goals. So, the key takeaway here is that companies can no longer say we didn't know what to report. The tools are available, the expectations are very, very clear. EU taxonomy and SFDR. So, let's look at Europe where ESG regulation is most advanced. So, two major initiatives are reshaping the ESG disclosure and finance across the European Union. First is EU taxonomy. Now, this is a classification system that defines what constitutes an environmentally sustainable economic activity. It is detailed, technical, and meant to avoid greenwashing. For example, if a company says its project is green, the EU taxonomy helps verify if it really is based on science based thresholds like emissions per kWh or waste reduction percentages. Then there is SFDR, Sustainable Finance Disclosure Regulation. What it requires asset managers, insurers, and advisors to disclose how they integrate ESG into their investment decisions and how sustainable their portfolios really are. These rules are designed to make ESG transparent, measurable, and comparable, and they are influencing policy far beyond Europe. Global firms seeking European investors or customers must comply, making this a global baseline altogether. Let's turn to India, where ESG regulation is gradually but quickly catching up. So, the Securities and Exchange Board of India, SEBI, has introduced the Business Responsibility and Sustainability Report Framework, also popularly known as BRSR framework, now mandatory for the top 1,000 listed companies. So, what does it require? It requires disclosure on emissions, water, and energy usage very clearly. It requires information on diversity, inclusion, and labor policies. It requires insights into governance structures and stakeholder engagement. Now, what makes BRSR unique is its focus on quantitative metrics and not just the narratives. It also emphasizes India specific priorities like local sourcing, community development, and overall inclusive growth. India is also seeing rising interest in green bonds, carbon markets, and ESG rating indices. And regulators are sending a clear message: ESG is not optional, it is indeed the future of capital markets. Now, let's talk a little bit about the greenwashing and enforcement trends. So as ESG becomes more and more popular, a new risk has emerged which is popularly known as greenwashing. Greenwashing actually refers to the companies exaggerating or falsifying their ESG claims to appear more sustainable than they actually are. So, few examples here include banks financing fossil fuel projects while promoting green funds. So, you can't do contradictory things at a time, right? Consumer brands claiming carbon neutrality without evidence. Firms publishing glossy and nice looking ESG reports with no independent verification. So, in order to manage these kind of issues and to fight this, regulators and watchdogs they are stepping in. So, the US SEC has proposed new climate disclosure rules and is investigating ESG funds for all the misleading claims. The European Union is introducing rules requiring fund managers to back up ESG labels with very, very hard data. And India is exploring ESG fund guidelines through SEBI and RBI. So, ESG reporting will increasingly require third party assurance, auditable metrics, and penalties for false claims. In short, the era of marketing led sustainability is ending, and this is a new area which we are entering into the age of very, very evidence based ESG. So, let's summarize about the ESG regulations. So, we discussed that ESG reporting is moving from optional to mandatory in many markets. Global standards like GRI, SASB, TCFD, and ISSB are shaping the disclosures. The EU's taxonomy and SFDR are raising the bar on green finance transparency. And India's BRSR is a bold move towards structured ESG accountability. Regulators are cracking down on greenwashing, emphasizing the need for honesty, consistency, and verification. So, for companies and investors alike, this isn't about compliance alone. It's about the trust, it's about access, it's about overall future readiness. Now that we have explored what ESG means and how it's being regulated, let's turn our attention to one of its most powerful forces investing. So, ESG is no longer just a reporting framework, it has become a major investment thesis. Global ESG assets are projected to surpass approximately $50 trillion by 2025. This accounts for over third of global assets under management. Now, this isn't driven by technology alone. Investors are now asking how sustainable is this company's business model? What environment or social risk could disrupt its revenue? Is the governance structure enough to protect value? So, with this, let's unpack the key components of ESG investing from strategies and ratings to trends and impact. So, ESG investing isn't like one size fits all. In fact, there are several approaches, each with its own goals and methods. So, first is exclusionary, which is negative screening. It means that you avoid investing in industries like tobacco, weapons, fossil fuels, and gambling. Second is it's primarily this kind of theme is simple to implement, but it may limit diversification, right? Second is the best in class positive screening. So what that means is invest in companies that lead to ESG that basically lead or outperform on ESG performance within their sector. What that does is it encourages competition to improve the ESG scores. Third is thematic investing. What it means is that you invest based on themes like clean energy, water, gender equity, or circular economy. This is often linked to long term megatrends. And fourth is impact investing. You invest with the intention of generating measurable social or environmental impact alongside the financial return. Examples include microfinance or affordable housing or renewable energy. And then fifth is ESG integration. What that means is you embed ESG data directly into the financial analysis and portfolio construction. So now considered best practice by the institutional investors. So each strategy reflects different levels of engagement, different levels of measurement and ambition. The key here is intentionality. It means that you how do you align capital with values and risks. That is the key intention. Now to support these strategies, investors rely on the ESG ratings. ESG ratings are the third party assessments of a company's performance across environmental, social, and governance metrics. Major providers of these include MSCI, there are MSCI ESG ratings, then Sustainalytics, it is by Morningstar, then there is called Refinitiv ESG, Bloomberg ESG. So these ratings assess everything from carbon emissions and board diversity to water usage and anti-corruption policies. However, there is a catch. ESG ratings are not standardized. One agency might rate a company A plus while another gives it as a triple B. This is because they use different methodologies, different weightings, and data scores. As a consequence, investors are increasingly calling in for transparency and convergence in ESG ratings. In parallel, ESG indexes such as FTSE for Good, S&P 500 ESG, Nifty ESG 100, they help track and benchmark sustainable portfolios. Passive funds and ETFs often use these indexes to allocate capital. So the message is very clear. ESG scores are now core investment signals and they are not side notes. Beyond equities, ESG principles are transforming into the entire finance ecosystem. So key trends in sustainable finance they include green bonds. So green bonds are the debt instruments used to finance environmentally friendly projects like renewable energy, energy efficiency or clean transportation. Then there is something called as sustainability linked loans. It means the loans where interest rates are tied to the borrower's achievement of ESG goals. For example, reducing carbon intensity or increasing board diversity. Then there is something called as climate finance, which means capital mobilized for climate mitigation and adaptation, especially in the developing countries. Also, there is something known as ESG screening in credit and insurance, which means that banks and insurance are often using the ESG criteria to price risk and approve loans and underwrite the policies. In the private equity and the venture capital space, there is increasingly interest in ESG aligned startups, particularly in climate tech, health equity, and ethical AI. So, together, these trends are reshaping the capital markets. There are these trends in sustainable finance which are reshaping the capital markets, and ESG is no longer a filter, it's becoming a driver for innovation for growth. Let's talk about little bit about retail versus institutional ESG investing. So another important distinction lies in who is driving the ESG investing and why. So for retail investors, individuals are increasingly demanding portfolios aligned with their values. Millennials and Gen Z in particular, they expect transparency, impact, and purpose. Robo advisors and digital platforms now offer clear ESG screening and thematic portfolios. So far as institutional investors are concerned, their pension funds, sovereign wealth funds, and asset managers, they are integrating ESG across trillions in assets and motivated by the long term. And risk management, regulatory compliance, and stakeholder pressure. These are another motivating factors or the factors which have led to increased adoption of ESG by the institutional investors. Firms like BlackRock, Vanguard, they are leading the charge. Interestingly, the institutional adoption is driving standards and influence, while retail investors are pushing innovation and accessibility. So, in the future, the line between the two will blur, in my view, and ESG becomes embedded more into default investment options across the board. So, let's discuss the key takeaways of this module of ESG investing. So, we discussed that ESG investing has become a mainstream force in global finance. There are multiple strategies which exist from exclusionary to impact focused. ESG ratings and indexes are shaping capital allocation despite the current inconsistencies. There are tools, green finance tools like bonds and sustainability linked loans, they are growing rapidly. Both the retail and institutional investors are driving demand, changing the purpose of capital. So, in this age of ESG, investing isn't just about the risk and return. It's about the responsibility and redefining what value truly means across all classes of investors. So, as ESG evolves from an ethical commitment to a strategic imperative, technology is stepping up as both as an enabler and a catalyst. So, from real time data tracking to immutable records and predictive analytics, the role of technology in ESG cannot be overstated. In this section of technological innovations in ESG, we are going to explore how innovations like artificial intelligence, blockchain, the Internet of Things, and digital platforms they are reshaping the way how companies measure, manage, and communicate the ESG performance. Now, artificial intelligence and data analytics are transforming the ESG reporting and decision making. So, automated ESG data extraction, let's discuss about it. So, instead of relying on manual processes or static reports, AI driven tools can automatically extract the ESG data from multiple sources, regulatory filings, news articles, and social media, providing a more comprehensive view of the company's impact. Then there is risk detection and forecasting. So, predictive analytics can help anticipate environmental or social risks, such as supply chain disruptions due to climate events or reputational damage from labor issues. Then comes the benchmarking and scoring. So, now sophisticated scoring algorithms are now being used to benchmark companies against their peers on ESG metrics. This helps investors and regulators make informed decisions. What's the result? The result is faster, more accurate insights that drive the action. So, now let's discuss a little bit about the blockchain for supply chain transparency. So, blockchain technology is bringing trust and traceability to the ESG reporting, especially in the complex global supply chains. So, few examples are immutable ledgers. By creating the tamper proof records, blockchain is ensuring that information like carbon credits or fair trade certifications can't be altered or forged. Then, tracking the carbon credits and labor certifications. So, blockchain is making it possible to verify the authenticity of the sustainability claims and ensuring compliance with the ethical labor practices. Then let's discuss about fighting greenwashing. So with blockchain, ESG claims aren't just simple statements, they are verifiable facts. This is particularly crucial for industries like agriculture, mining, and fashion, where transparency is very hard to achieve. Moving on, let's discuss about the Internet of Things. So the Internet of Things is actually enabling real-time environment monitoring across industries. So there are sensors track emissions, water and air quality. So there are devices placed in factories, offices, and even transport vehicles. They can continuously monitor the environmental factors. Then there is real-time alerts. So there is immediate notification to enable companies to address issues like a gas leak or a excessive water use before they escalate to a higher level. A lot of developments has been made on the data driven compliance category. So what internet of things is doing is it generates data, supports compliance reporting, reducing the burden of manual data collection and thereby increasing the accuracy. So think of IoT as the nervous system of ESG. It's detecting, it's responding, and it's documenting the environmental impact at scale. This is my favorite area and favorite topic where let's discuss about the digital ESG dashboards and platforms. So now modern ESG management, they are increasingly reliant on digital platforms. So there is this called centralized monitoring. So companies are adopting the digital dashboards that integrate the ESG metrics from across the organization, giving executives and stakeholders a real-time snapshot of the performance. There is integration with the financial systems. So, by linking ESG data to financial reporting, companies now are showing how sustainability efforts are affecting profitability and risk. Then we have what is called as interactive stakeholder tools. So, these platforms often include customizable views for different stakeholders. So, investors separately, regulators, employees, promoting clear transparency and engagement. Digital platforms, they are no longer optional, they are very essential for scalable ESG management. So with this, now let's recap the transformative role of technology in ESG. So technology is accelerating the accuracy, accessibility and actionability of the ESG data. Tools like AI, blockchain, and Internet of Things or IoT enable the transparency and accountability. Digital platforms, they are turning ESG management into a very interactive enterprise-wide capability. And innovation isn't just helpful, it is very necessary now for ESG to scale and deliver impact. While ESG has become a powerful force in business and finance, its implementation is far from smooth. So companies face multiple challenges ranging from data gaps and inconsistent standards to profitability concerns and stakeholder misalignment. So let's dive into these challenges, not to discourage the ESG adoption as such, but to highlight areas where vigilance and innovation are needed. So data quality and availability. See, data is the backbone of ESG, but that backbone is often fractured. So, as we discussed earlier, there are non-standard metrics. Companies report ESG data using different formats, making comparisons very difficult. Then there is self-reported information. So much ESG data comes directly from the companies themselves. They raise concerns about the accuracy and the biasness. And then there is lack of real-time updates because without the current data, risk assessment and decisions may be based on outdated information. So to overcome these hurdles, firms need robust data management, they need third-party verification and continuous monitoring is also needed. Now let's discuss about the standardization gaps. So right now there is no universal ESG playbook yet. There are confusion from multiple frameworks with GRI, SASB, TCFD, and now ISSB. Companies really struggle to navigate which standards to adopt. Then there is this inconsistent application. So ESG reporting actually varies by geography, sector, and even company size, creating very uneven benchmarks. So a single auditable ESG standard would actually bring clarity and trust to the market. Until then, companies must harmonize their reporting with multiple frameworks to just meet stakeholder expectations. Now, let's talk about this interesting topic of ESG versus profitability debate. So, a myth suggests that ESG hurts profitability, and the reality is actually more nuanced. So, critics argue that sustainability investments, they actually reduce short-term returns. However, long term data increasingly shows that ESG aligned firms are more resilient, innovative, and attractive to investors. Then some sectors like mining or aviation, they face steeper ESG integration costs, but these are often offset by the reduced risks and new opportunities. So the debate is shifting from does ESG hurt profits to how does ESG drive sustainable value of the firm. Now, different stakeholders, investors, regulators, employees, and the public, they often have conflicting ESG priorities. Companies must decide which ESG issues are financially material versus ethically significant. Then there is an important need to secure support across departments and leadership levels. It is crucial, but it is challenging. Further, meeting diverse expectations while maintaining operational efficiency that requires careful strategy. So addressing misalignment isn't about pleasing everyone, it's more about clarity, communication, and prioritization. So to summarize this section, ESG challenges are real but manageable with strategic focus. Data quality, standardization, and alignment, they need immediate and urgent attention. Long term resilience and stakeholder trust, they outweigh the short term hurdles. And transparency, consistency, and engagement, they are very, very essential for navigating the ESG complexity. Now, let's discuss about case studies and the real world impact. So, understanding ESG in theory is one thing, and seeing it in action is another thing. Real world case studies here provides concrete evidence of how ESG can drive value, enhance resilience, and deliver measurable impact. So in this section, we are going to explore examples from multinational corporations, influential investors, governments, and innovative startups. These stories will highlight how ESG principles are being embedded into strategy, operations, and leadership to create tangible change. Unilever's ESG model. So Unilever stands out as a global leader in ESG integration. So there are sustainable brands. Unilever has committed to making sustainable living commonplace. Its portfolio include brands like Dove, Ben and Jerry's, like that, which focus on environmental stewardship and social impact. Unilever is also pioneering circular business models, designing products for reuse, recycling, and very, very minimal waste. Further, there are transparent goals. Unilever publicly shares its emission targets, water conservation plans, and diversity metrics, linking these clearly to financial performance. And studies show that Unilever's sustainable brands grow faster and are more profitable than others in its portfolio, demonstrating that ESG is not just ethical, it is actually strategic. Now let's discuss about this case study of BlackRock. So BlackRock, the world's largest asset manager, they have been a vocal advocate for ESG integration. So BlackRock CEO Mr. Larry Fink, he has repeatedly emphasized that climate risk is investment risk. The firm integrates ESG factors into its decision-making process across trillions of dollars in assets. What BlackRock also does is it uses its shareholder voting power to push portfolio companies towards better ESG practices, whether it is on emissions or board diversity or social issues. If you look at the firm's annual letters and stewardship reports, you will find they hold companies accountable, reinforcing the message that ESG is now a boardroom priority. So, BlackRock leadership, they are clearly showing how financial institutions can catalyze ESG adoption at scale, and other firms should actually learn and implement the similar kind of things and processes as BlackRock has done. Now let's discuss about this policy case of Norway's sovereign fund. So Norway's government pension fund, often called the world's largest sovereign wealth fund, it has integrated ESG into its investment strategy. So the fund has divested from companies involved in tobacco, coal, weapons, and severe human rights violations. It engages with companies on ESG issues, encouraging better practices and greater transparency. So, with over $1 trillion in assets, the fund is set and is setting a high bar for ESG performance and inspires similar actions by the other institutional investors. This case clearly illustrates how national policies can shape global ESG norms and expectations. This is my favorite. Let's talk about ESG tech in India. So, India startups ecosystem is contributing to the ESG movement with very, very innovative solutions. So, there are carbon accounting tools. So, startups like Climbs and Renew Power, they are developing digital platforms for accurate carbon tracking and offsetting, enabling companies to meet India's growing regulatory requirements. And remember, we spoke about BRSR. So, with SEBI's Business Responsibility and Sustainability Report (BRSR) framework in place, startups are helping SMEs navigate the ESG reporting and certification. And there are other innovations as well. So, from renewable energy to inclusive AI tools, India's startups are solving local and global challenges, proving that ESG is not just for corporates, it's an entrepreneurial opportunity. So, what can we learn from these real world examples? So, ESG is already delivering tangible business results, improving growth, resilience, and trust all across. Large corporations, institutional investors, national funds, and startups, they are all playing critical roles in shaping the ESG landscape. Further, innovation, transparency, and stakeholder management, they are actually the key drivers of ESG success. And the future of ESG is not limited to policy or compliance. It's always about strategy, leadership, and long term impact. The future of ESG. So, ESG has come a long way from a niche concept to a mainstream business strategy. But where is it heading next? So, in this final section, we are going to explore how ESG is evolving from compliance to core strategy, the role of youth and consumer activism, the convergence with impact investing, and what this means for business of all sizes. So, ESG 2.0, from compliance to strategy. The future of ESG lies in innovation and integration, from box ticking to actually core strategy. So, what that means is that ESG is no longer about checking regulatory boxes, it's about embedding sustainability into the business models, value propositions, and corporate culture. Further, it has been linked to innovation and growth. So, companies are realizing that ESG isn't just risk mitigation, it's a driver of new products, markets, and revenue streams. What we have seen is that ESG aligned firms are better equipped to handle shocks from climate events to social upheavals, enhancing long term resilience and competitiveness. Now, let's talk about the role of youth and consumer activism. So, a powerful force shaping the future of ESG is the rise of socially conscious consumers and young investors. So millennials and Gen Z, they are expecting companies to reflect their values on climate, equity, privacy, and ethics. ESG issues, we have seen that they go viral in minutes, holding companies accountable in very, very real time. And there are value driven choices, like from boycotts to brand loyalty. Consumers are increasingly rewarding companies that walk the ESG talk. So businesses that ignore those expectations risk losing market share, talent, and reputation. Now we are witnessing a convergence of ESG and impact investing. So where the focus shifts from risk management to delivering measurable positive outcomes. So future ESG reporting will not only consider risks to the business but also the business impact on the society and the planet. We see that ESG is becoming the entry point for deeper impact investing strategies that aligns capital with a clear purpose. And this evolution reflects a shift in investor mindset from how do we avoid harm to how do we create value for all the stakeholders. So ESG isn't just for large corporations. Smaller firms and newcomers can also lead the way. Few recommendations are that start with material issues. Focus on the ESG topics most relevant to your industry and stakeholders. Then SMEs should leverage the available tools, use open source frameworks, digital tools, and community resources to build your ESG strategy. Then they should also engage stakeholders. So transparency and dialogue with employees, customers, and investors, they build trust from the ground level up. And there is no hurry. The SMEs can build gradually. ESG maturity is a journey. Start small, learn continuously, and scale responsibly. So this brings us to the overall end of this module as well as the ESG course. And let's discuss the key takeaways. So we discussed ESG is evolving into a core strategic driver, not just a reporting exercise. Future ESG is proactive, digital, and inclusive, reflecting stakeholder values and societal impact. Youth and consumers, Gen Z, millennials, they are shaping expectations, they are demanding transparency and action. And within this entire ecosystem, everyone has a role to play. Whether you are a multinational, a startup, or you are an individual investor, or a SME, etc., etc., everyone has a role to play. The future belongs to those who lead with purpose, resilience, and responsibility. With this, we are wrapping up the ESG basic series. My name is Dinesh Sabu. I am a CFA charter holder. Thank you.